Hi everyone, welcome back to Be Rich. In our pursuit of talking about where to invest and how to invest for the year, I thought me and Shashwat will discuss today about what are the best and worst performing sectors in the stock market for the year 2023. Because we don't want to get into individual companies and individual shares because we are not advisors and we don't recommend shares in companies specifically. So we thought we'd broadly talk about sectors. This way we can avoid, showing any favoritism towards any one company or putting any one company down. We want to leave that up to your own analysis and your own understanding and your own due diligence. We thought out of academic interest, we will broadly talk about sectors which are doing well, sectors which are doing poorly, and why we think these sectors are doing poorly and why these sectors are doing well is something which we thought we'll touch upon. So, Shashwat, why don't you start us off with the best performing stock sectors for the 23?
Yeah. So one of the performing sectors has been the banking sector. So the banking sector has been one industry which has been delivering consistent returns over the past year. And you can figure this out by looking at the Bank Nifty, which consists of these banking stocks. And it's sort of an index for banks alone. And the banking sector has performed pretty well, with a lot of your private banks also doing pretty decently for themselves. So this is a sector which has been recovering from the battering which it received during COVID-19. And it was a true battering which these guys received because, first of all, interest rates were low. Secondly, people were defaulting on their loans. Thirdly, there was a moratorium which was installed, and it was basically a turbulent time if you're a bank. And now you see that these banks are reeling in from their losses, and their contingent funds are now reducing because the risk isn't as much anymore. There's no threat of the country going through a lockdown. So the banking sector is something which has been performing pretty well. And you do have something to say about the banking sector?
No, I agree with you completely. Your analysis of the banking sector is very true. But I do want to tell people there is a differentiation between public sector banks and private sector banks. Do not mix both of them. Public sector is different and private
Yeah.
sector banks are separate. So keep that in mind when you say banking sector has been doing well. It's talking about mainly private banks.
Yeah, and the next sector which has done well for itself has been the nifty FMCG, or your fast moving consumer goods. So your ITC and your Unilever, your Nestle, and all your
Correct.
other consumables. And these companies have been doing well because now people have gotten out of their houses, people are spending more. Even though there's a threat of slow economic growth, you see that these companies are unbridled in a way because you'll still need toothpastes, you'll still need your essential goods, and these sectors have products which you will be purchasing regardless of the economic situation. And that's why you've seen a resurgence in this sector. And even though there has been inflation, because of the inelasticity of these products, they've been able to pass on the price increase to the end consumer. So you've had concepts such as shrinkflation, which is your Lay's chips packet has still been the 10 rupees, but they've slowly reduced the amount of quantity of chips in there, and the amount of air in there is increased. And your packet of biscuits started weighing less. So this has been a popular tool of choice, and it's a psychological effect where people don't realize that they're paying more, in fact, for a lesser amount of goods. And this is what they use to pass on price increases, which is why inflation hasn't been so much of a problem for these companies. And in fact, it's been a sort of a friend for these companies. So the FMCG sector is something to look at.
Another thing is demand from rural sector has gone up. A lot of people after the lockdown went back to their villages, gone back to their C tier, D tier cities, and a lot of money has gone back there. And a lot of people work from home has been happening from there. So there's been an uptick on rural demand for all these FMCG products. So which has been doing very well for these companies such as Nestle, Hindustan Lever, ITC, Britannia. All of them are reaping huge dividends from this huge uptick from rural India. Which is what I wanted to add about.
Yeah. And thirdly, the other sector which has done well for itself has been the nifty automobiles. Automobiles have done fairly well for themselves, and this again comes from the K-shaped recovery which we've been talking about, where now the top class of India buying luxury cars. And you see that a lot of these companies which sell luxury cars are having a huge uptick in their demand because of the fact that the elite of India are now purchasing cars worth more than 15, 16 lakhs. And that has fueled an enormous this thing demand for these companies. Although if you look at it in terms of demand for inferior cars or cars which are more budget, that hasn't picked up as much. And demand for motorcycles has been in a downtrend for the past few years. So the huge demand which comes for cars has come from the K-shaped recovery funded by the elite of India. And the sector has automatically performed according to this increase in demand. And this sector is something to look at for people who want to diversify their portfolios.
Yeah, this is true. And the sector which I would like to talk about is first one is which is performing well is technology. Technology sector is doing very well. IT sector because of the rupee becoming more and more cheaper and the dollar becoming more and more expensive. That means you're getting more rupees for the dollar. So most of these IT companies are export companies, basically an export company if you look at it. They're exporting services outside India. The payments come in dollars, so their revenues have been uptick. Even if they've not increased their client shares, they've not increased the work. What's happened is just because of the rupee devaluing, their profits have been soaring. And your companies like HCL, TCS, all of them are doing very well. Infosys is doing very well. This whole sector is doing very well because of this reason. And the same knock-on effect is happening in healthcare. Most of the Indian healthcare companies are exporting. So all your pharma company in the pharma sectors are doing very well. Though they do have a lot of debt in these companies. They are very debt-heavy companies. They're also doing relatively well. So I thought maybe you can share your views on this, Shashwath.
Yeah, so the thing you rightly pointed out the fact that there's a dollar arbitrage to be made with these IT and pharma companies. The reason why these sectors have performed well over the past few years, but hasn't maybe performed as well over the past year is because of the rising interest rates which threaten economic output. So a lot of these pharmaceutical companies are selling goods abroad. Like you rightly said, they're earning in dollars. So if US economy is going to go into a recession, that definitely shows tough times ahead for these companies which earn their money in dollars. So that may be the reason why the stock market may not have seen the earning potential for these companies. That being said, it's prudent to note that there's a great thesis, or rather, there's a great idea behind why someone should look at IT companies and pharma companies, especially when they're getting battered.
Cool. And why don't we talk about the worst performing sectors in the stock market right now? I think these
Yeah.
are the softballs which you can hit out of the park quite easily, which have been performing
So,
quite badly for quite some time now.
yeah. The first one comes into play, which is the nifty metal. The metal sector has not been performing at its peak, but the interesting thing is there was a huge steel boom which happened in 2021, and then the government started taxing steel gains, all the windfall profits, because your companies like Tata Steel were able to drive down their debt by a huge amount due to this post-COVID steel boom which was occurring. But as with signs of a slowing economy, the first sector which does get impacted is the infrastructure and metal sector and your raw commodities, because these are your sectors which are telltale signs for how the economy is going to do. So if there is talk about an economic recession, you'll definitely see that these are the fundamental sectors which people will say, okay, wait, let's think before we invest in these sectors. So that's probably why I'd say be pretty wary and cautious. Although you have good buying opportunities when these companies are battered, because they're seasonal companies. So when they do get battered, you get very cheap discounts and you might be able to snag a few good companies at great prices. But beware, because these companies are burdened with a lot of debt.
True. Another sector which is doing very poorly is the real estate sector. Real estate sector is the biggest consumer of infrastructure sector, your steel and your cements. So when real estate sector is in doldrums, of course infrastructure will be in doldrums. Real estate sector includes companies like Godrej Properties, Oberoi Realty, DLF, Shobha. So some of them are individually maybe doing okay, some of them are doing individually not so well, but the sector as a whole is very sick. It's been sick for quite some time. And going forward, looking at the interest rates where they are heading, real estate sector is going to be still getting hammered for the coming year or two. I don't see any huge recovery happening in real estate sector. What do you think, Shashwat?
I mean, I completely agree. And plus, for real estate, what you really need is low interest rates, because you need people to be wanting to take loans and you want people to buy properties on loans. And if your interest rate is rising, the cost of buying a property in real terms is rising. Even if prices don't increase, what ends up happening is because the borrowing costs have increased, people are more, defensive when it comes to buying real estate. And a lot of corporate real estate has been made redundant because work from home has been such a big disruptor in the economy. that you have multiple people just be willing to work from home rather than come in a leased property which has been built specifically for a certain company. So these are factors which are weighing down the sector, and there's no telling when the sector is going to wake up and decide to perform better.
And always remember, real estate sector is a lag. So a lot of people will be looking at their city, like in Bangalore, and you'll be thinking, oh, there's a lot of construction going on. There's lots of empty buildings. There's a lot of activity. People are going back to office. Recently TCS told all its employees, please come back 100% back to work. No question about working from home at all. Yes, all these are true. But the headwinds we're talking about, the roll-on effect is going to come slowly in the coming months. What you're seeing is the past. So this is all the past demand and the past things which are flushing into the market. So real estate sector going forward, it is going to get very soft. So this is what me and Sashwath do feel.
Just one more point for these companies. I talked about the effect of debt on individuals, but there's also the effect of debt on these companies because a lot of these builders don't foot the entire bill themselves. They borrow a little bit in order to be able to fund these properties. So we have a double whammy effect here because with rising interest rates, you have real estate developers who are now paying higher costs to be able to develop properties. Number two, you also have consumers who are not able to pay as much for these properties. So there's a double whammy effect for the industry.
Correct. So, like Shashwat and me have been discussing, these are the basic, broadly speaking, the sectors which are doing well and the sectors which are doing badly. But as an investor, what you can do, like what Shashwat has said a few minutes back, that you should analyze individual companies, look at the debt on each of these companies, look at the promoters on these companies, and see the track record of these companies. Because there are bargains to be bought. When a whole sector gets depressed, when a whole sector is being fled by the FIIs, there are cheap companies which are good companies. And like he said, these are cyclical industries. So some of them are right now going through a downward spiral. And it's a good time to enter if you are looking at entering. And the same way, reverse is true. There's a lot of sectors which are performing. Maybe they've reached their peak. And if you're heavily invested in these sectors, maybe it's time you book your profits and take your money out and move them into sectors which are in the downward. So you have an opportunity to improve your investments and improve your money. So these are something to consider. What do you think, Sashwath?
Yeah, and the only caveat which I'd add is it's very frustrating to have caveats because investing is not as simple as people want it to be. The caveat here is that yes, you do get assets in at battered prices in cyclical stocks, but what you have to understand is you can't predict how long the cycle will go. So if you want to book your profits in 3 years or 4 years, there's no guarantee that you can. You don't know how long the cycle lasts. Sometimes the cycle can be a few years, sometimes it can stretch a decade. You have no clue about what's going to happen in terms of the duration. So, people trying to time the market, this may not be the strategy for you.
True. So that being said, please do keep in mind we are not advisors, we are not SEBI authorized, we are not anywhere near close to telling you what to buy, what not to buy. These are broadly just our views and what we're talking about where the market is currently, where it's sitting at. We just wanted to share this information with you so it gives you food for thought, something maybe for you to think about when you're investing or when you're thinking about investing, on which sectors you can look at, which sectors maybe you can avoid. Broadly speaking, that's about it. So please do remember that we are not advisors. And we'd like to thank you again for joining us today on Be Rich. I hope you found this information, this video interesting. If you did, please do subscribe to our channel, turn on the bell notification so you'll be notified every time we come up with a new video. Again, I'd like to thank you for joining us on Be Rich.
Thank you.
I will be in Kuala Lumpur, Malaysia on the 11th of June this year. That is a Sunday. I want to meet you guys at Sheraton Imperial Hotel between 4 p.m. and 7 p.m. on that day. The Sheraton Imperial Hotel is in Jalan Sultan Ismail area near Quill City Mall. The Kuala Lumpur monorail railway station is available nearby. You can meet me there. For further details, you can contact us on the WhatsApp number below or send us an email at the email given below. My team will contact you at the earliest. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.